Great day, everybody. Hope everybody's well, everybody's blessed and balanced. Hope everybody's been eating their fruit, getting some sun exposure. I don't know about y'all, but man, some wicked came through and hit the household last week. I'm still recovering the last 5% or so. So I apologize if I sound a little bit off. Um, but anyhow, hope everybody is taking care of themselves, taking care of their health. But today is a Thursday, October 5th. It's actually my stepfather's birthday day. So let's wish Earl the Bassman White a happy birthday, send him those vibes. But today we are back at it, back on campus, Third Academy, a bit of the block, and we're gonna build on the conversation that we had last time. Now, for those who are returning and joining us, appreciate you making the time to be here for that prior conversation. But if you happened to miss it, we spoke about wallets, we spoke about self custody, and that is a fundamental quality aspect of Web3, crypto, blockchain, all of it. And so, in reflection, actually, this was planned out ahead of time. But either way, knowing that, figured that one of the best ways to follow on that conversation would be to talk about Bitcoin. So, as you can see, and as you can see, that's what we're going to go over today. Now, uh, we're going to talk about not just the history of Bitcoin, but we're going to speak about more of how it works at a fundamental level. There are a lot of people who know a lot of these more nuanced aspects of Bitcoin, but there's far more people who don't. So we're going to cover some of that. We're going to get into the history and work through some different aspects. But today is a conversation about Bitcoin. So before we really kick things off, we're going to go ahead and transition it outside. We have another one of these posted up out there. So I'm going to take a little stroll, meander over that way, grab anything you might need for really lock in and get going in this conversation and really kick it off about Bitcoin. So if you could do me a favor, Paige, and run it back to the start of the presentation and get us queued up there. And then we'll really kick this off in earnest in a few moments. If I bump into anybody, that's entirely unintentional. Find the sound of the natural elements. They help open one up to receive information. Okay. So, Bitcoin, the original cryptocurrency. Start off with a little bit of a quote from none other than Satoshi Nakamoto. Second slide, please, Paige. This is one later in the deck. But I'll go ahead and read it out. The quote goes, "The root problem with conventional currency is all the trust that's required to make it work. And the history of fiat currencies is full of breaches of that trust." Satoshi Nakamoto. So there's a lot to unpack here in this quote, and a lot of it builds on the conversation that we had last time about self-custody of assets. And as Satoshi Nakamoto, who happens to be the founder, heralded as the creator of Bitcoin, that's the whole idea when people speak about blockchains or Web3 and trustlessness. That is really what it speaks to, is not needing to trust an intermediary or a third party and really being able to verify that something is so rather than trust and believe that that information uh, is true, even without being able to prove it. And over time in history, we've seen in many different situations that when people are forced to simply trust an institution, that usually at some point on some time scale, when long enough, that trust is violated. So, really kicking it off, what is Bitcoin? There are three aspects to Bitcoin that I think are fundamental to appreciating the innovation that it is. One, that it is decentralized. In particular, what it means is it is peer to peer. The second one being that it is built on top of a blockchain. Bitcoin is a blockchain, and Bitcoin is also a cryptocurrency. Uh, and then the third one being that is digitally native value. And I would argue, many would argue, that it was the first time, uh, the first instance of digitally native value really being displayed. So, starting back at the decentralized side of it, Bitcoin was designed to be transacted peer to peer. And everything really about Bitcoin, from the transaction aspect of it, as well as how it is actually created and mined, operates in a peer to peer fashion. And as such, it removes the need for these trusted third parties and intermediaries. Now, the second aspect of it being on a permanent ledger. Part of what blockchains really enable, if we assume that these are permissionless blockchains, meaning that anybody can access them, uh, they really popularized what is known as triple entry accounting. And there's a lot that you can look up on this, but effectively, what it means is that every transaction that takes place is viewable by everybody. The person who made the transaction, uh, whoever may be on the other side or otherwise involved in that transaction, as well as people who have no direct engagement or relationship to the transaction or the parties making the transaction. Everybody is able to see it. Everybody is able to also see the chronology and the history of when these transactions took place. It's fully auditable. All right. And this goes back to removing the trust. And then the third part being digitally native value. I encourage anybody to think about the last time that they actually spent cash in a place. For some people, that might have been today, that might have been this week, may have been this month. But for plenty of people, you may struggle to think, dang, when was the last time I actually spent cash on something? We saw in 2020, there were many businesses that actually said, hey, you are no longer allowed to spend cash with us. There has to be a card payment or Apple Pay or Google Pay or something of that effect. However, none of those things are actually digitally native value, right? They're abstractions of the same old banking rails being moved on the backside. Where with Bitcoin, and this was the first cryptocurrency to actually do this, when you send Bitcoin to somebody else, once they receive it, they actually have the Bitcoin. The Bitcoin itself is in their possession, is no longer in your possession. And this makes a lot more sense, you could argue, in a digitally first, a digitally native world. So, next slide, please. So, how does Bitcoin actually work? Well, a big part of what makes Bitcoin work is the mining process. And basically, what happens here is that people volunteer, they donate computational resources to help secure the network. The more people who are running nodes and running miners, the more secure, cryptographically speaking, and hash power wise, the network becomes. And as let me slow it down. This is known as a consensus mechanism. And every blockchain requires one. It basically is the path through which all of the participants in the network are able to agree on the state of the ledger, i.e., consensus. And what Bitcoin uses is known as proof of work. And that is why when people contribute the resources of their computer, the hash rate is what it's known as, they are demonstrating, they are proving that they are putting work, dedicating resources, computational work to securing this network. And in exchange, they're actually given a reward as an incentive. And this reward is known as the block reward because this is very computationally demanding on the computers and on the miners. And they solve what's known as a SHA-256 hash equation, which basically is just this really difficult piece of code, right? It's like you're in math class and your teacher says, okay, what's 1 + 1? That's not very hard. But they start asking you the square root of this number raised to the 7th power, and then to pull a derivative on it, it can get increasingly complex. And so the block reward is really a capitalist mechanism designed to persuade people to devote computational resourcing to this network. And it was really a means to solve the problem of a cold start ecosystem when Bitcoin first went live. The question was, why would somebody run their computer and dedicate their resources to this? Mind you, Bitcoin was not worth 24,000, 26,000, 30,000, $60,000. It was worth nothing at the time. But people were able to receive Bitcoin in exchange every time they solved the block equation. And over time, every 4 years roughly, the amount of Bitcoin that was rewarded to miners, that number gets cut in half. And it gets cut in half every 4 years. So it becomes increasingly difficult to actually acquire new Bitcoin when you dedicate your resources, which makes it more competitive for the miners. But it also means that the velocity with which Bitcoin enters the circulation, it slows and it slows and it slows further over time. All right, next slide, please. So, like anything, there are some pros and cons to this particular technology. Now, some of the pros with Bitcoin in particular is that it is relatively stable and time tested in the grand scheme of crypto. It was the first one, it's been around the longest, and it's had the fewest technical issues, but that's also because it's had the fewest technical changes. Uh, it's demonstrated itself to be secure and attack resistant. The blockchain has never been hacked, it's never been compromised. It is the most decentralized of any of the blockchains that are out there. And it is the most well studied and researched of all the chains and networks. Now, on the downside, it has a very low throughput, a very low TPS, transactions per second. This is one of the reasons why we've seen people build things like Lightning as a means to try and make the Bitcoin more suitable for real-time payments. But as it stands at the base layer of Bitcoin, it is very low throughput. It has limited capability. And what I mean by that is there is very little you can do with Bitcoin with its base architecture. It was never designed to be a smart contract platform, so it was never intended for people to really build applications on top of it, but rather to serve as a immutable ledger that people could track transactions over time and space with. The other con is that it is very energy intensive relative to things like Ethereum or Polygon, particularly Ethereum after its EIP 1559 upgrade. And then the last con is that it is a relatively walled garden of an ecosystem, meaning that it is very difficult to make Bitcoin interoperable with Ethereum or with Solana or with any of these other major ecosystems that we see. All right, so let's hit the next slide. And then after this slide, we're going to meander on over to another part of this campus. So before we do that, we're going to talk about the team. On the pros, it's a very focused team. Bitcoin is all they work on, and they are very diligent about making any changes. And they're particular in focus on the economic and the monetary efficiency of Bitcoin. As we spoke about, they're very diligent, very patient. They're not in a hurry to change anything. They have a proven track record, and they have weak to no leadership. Now, the reason that this is actually a pro is because it helps the decentralization. If Vitalik Buterin tomorrow said that he no longer supported Ethereum or that it was fundamentally broken in some way, shape, or form, the price would take a substantial hit, almost guaranteed. Because, like it or not, Vitalik is a bit of a centralizing force around Ethereum. What he believes, what he thinks, what he does has an outsized effect on the ecosystem. There is no such counterparty to point to in the world of Bitcoin. The best thing you could point to is Satoshi Nakamoto, but as far as anybody can discern, he doesn't exist. He is a pseudonym, and that pseudonym might represent a conglomerate of people, right, or multiple people. But either way, Satoshi has not uttered, he has not sent an email, he has not posted on a forum in over a decade. Now the cons. Weak to no leadership. As beneficial as having no leaders is to the decentralization of a network like Bitcoin, it also means that it is very difficult to rally people to move any particular initiative forward, or to have anybody that can serve as the go-to when media wants someone to speak to or they want to get an opinion about something like Bitcoin. Excuse me. Now, beyond that, it's a relatively small team, especially when compared with the number of developers that are building on something like Ethereum. You could say that the team is complacent, and by that I mean that a lot of the core developers around Bitcoin, they feel that Bitcoin is basically done in its base form, that it is working towards its objectives, and that there really isn't anything to change or to improve about. And then it can be a bit of a maximalistic and tribal group of people, in that a lot of folks who are the strongest supporters of Bitcoin, there tends to be a correlation with that cohort, a correlation with people who think that anything outside of Bitcoin is superfluous or is a scam or is otherwise a waste of intellectual and financial resources. And as a result, there's often a bit of a winner take all mentality within the core developer ecosystem or core community of Bitcoin users or Bitcoin maximalists, that at the end of the day, most other protocols besides Bitcoin have little to no value, and that all of the value will accrue to Bitcoin eventually. All right, so let us go ahead.
Sae'Von,
Yeah, go ahead.
Before you move, I have a really fundamental question. What
Yes,
gives,
please.
other than the trading dynamic, what gives Bitcoin any valuation at all? Any value at
I'm
all?
so glad you asked that, my brother, because there are several ways actually to value Bitcoin. So let's talk about them. One, you can think about Bitcoin. I think this is one that a lot of people can wrap their heads around. You could think of Bitcoin as an abstraction of the electricity that has gone into securing the network, right? Like, for instance, we all have our homes powered, these computers, these devices that we're on right now. There is something that is powering them, whether that be more combustible, whether that be a renewable. There was some form of energy that is being used to power it, that gets sent to our home, your vehicle, whatever it might be. But other than looking at some energy companies, how do you really value or place value on the energy that is being sent to that computer? Like, sure, your energy company, they charge you a price per kilowatt hour, but how do they really come up with that? And different regions price it differently. Energy is much more expensive in California than it is in Georgia, than it is in Tanzania. And so Bitcoin, interestingly, because of the dynamics of how new Bitcoin are created through this mining process, through proof of work. One could argue that the price of Bitcoin, whatever it's trading at in the market, is a abstraction of all of that energy that has gone into creating and bringing a new Bitcoin to market, paired with actually securing that network. And that's one way that you could say the value of Bitcoin represents, or Bitcoin's price represents that value. Now, connected to that in a way is the idea of what is the value, or how do we place value on computational resources? I think that many are able to grasp or would not disagree with the premise that as we move deeper into this more tech forward, tech driven landscape, as AI becomes ever increasingly embedded throughout society, throughout different products, computational resources are valuable, specifically computing power, compute, right? You can see this when you look at the stock market and you look at the price of something like AMD or NVIDIA. Their valuations have increased as their demand has gone up. And things like needing hardware chips to run these AI transformers has shown that these companies are increasingly valuable. At least that's what the market has decided. So, what does it mean to value the most powerful computational network on planet Earth? Which, if you didn't already see the punchline coming, is Bitcoin. A lot of people don't know that. If you're talking about any one singular computational network based on hash power, which is a measurement for computational power, Bitcoin is the strongest, most resilient, most powerful single computational network on Earth. So again, what is that worth? We see what NVIDIA is worth. We see what AMD is worth. We see what some of these other companies that are proxies to the AI race are worth. What's the strongest network on Earth worth? Who's to say? Bitcoin. Yeah, go ahead.
Sorry to interrupt, but that's really a good explanation. But a question, I just had the good fortune to be in Iceland. And
Yes.
as we were driving out of the airport, there were these two giant black buildings that were,
Yes.
glass enclosed buildings, and they were really cool looking. And they turned out to be Bitcoin mining centers.
Yes.
So they use those two facilities, and there may be a couple others on the island, because Iceland uses geothermal energy from all the volcanic activity. They use more; those facilities use more energy than the whole rest of Iceland combined. You can believe that. That's a lot of energy. Oh, there's only 400,000 people in Iceland. So worldwide, it's not that much energy. But based on the population, they actually use more energy mining Bitcoin than the rest of the country uses to live.
Yeah, that's wild if that is true. And I've heard similar things before. Uh, and again, I mean, I'm not here to say, right or wrong, but I do think it's fascinating to see that sort of mobilization of resourcing towards something like that. And I think that again, it's also a testament to where we are as a society, right? That this magical internet money that came out of somebody writing a few lines of code is able to mobilize within less than 2 decades more than the aggregate amount of energy being consumed by an entire country's population, simply to put towards securing and generating more of this particular asset. Um, and it's rare that you see that sort of thing inside of capital markets. You have to have typically these incredible incentivization structures, and usually so much coordination from a corporate standpoint. But the fact that they didn't have to ask anybody at Bitcoin headquarters if they could do it. They didn't have to fill out an application with Bitcoin to get qualified or certified as a vendor or someone who could partake in this exercise. All of the permissions and red tape they had to go through were from governments, not from Bitcoin. Bitcoin didn't ask them to do it. It put out an incentivization, but it never told them how they needed to go about it. So it's a really interesting dynamic. And obviously, there are people who feel very strongly that too much energy is being dedicated towards it. But again, it's not really my place to dictate whether that's a good or poor use of resources. But anybody who might have reservations about it, I would encourage them to really dive deep to assess the energy resourcing that goes to other things that they use in their life. I think we talked about this in the last show, but how much energy does Facebook use to keep its servers up? Power Facebook Marketplace, right? Or Messenger, or Instagram, or TikTok. These are things that I don't ever read in the headlines, but I definitely read about the amount of energy that Bitcoin uses, and it's far less than a lot of these other corporations use. So there are about 7 or 8 other ways that that people, depending on their background, use to value Bitcoin. But in summary, one of them is its value as an inflation hedge. Another one is its value as a provably scarce asset, and arguably one of the only provably scarce assets known to man at this point. Even when we look at what people typically point to as scarce assets like gold, well, there's actually no way to prove the supply of gold, nor to disprove that there will ever be another large deposit found, whether that be currently already on Earth or from some meteor or some outside force bringing it into our realm. So it's interesting in that sense that prior to Bitcoin, there was never really any asset that you could actually prove to be scarce, and that has continued to show itself as scarce. So some people value it that way. Some people value it as being the only really decentralized currency in existence. And by decentralized, part of what I mean there is neutral from a governmental standpoint. As we did talk about in the prior show on self-custody, regardless, again, of your political views and opinions, the fact that an entire country, and mind you, more importantly, the citizens of that country, who are not the people, the dictators, but just the citizens, who many of which cannot help where they were born, they get shut out entirely from the global financial system because a few other countries decide that that's the best way to wage financial war and put pressure and leverage on this entity to in hopes of making it change their decision. But these people suffer from that. And Bitcoin, again, no one needs to ask permission to use it as a network to send currency or to store value. And we're seeing that become increasingly valuable to a lot of these nations that are opposed to the West or have different objectives to the West, because they know that Bitcoin as a network can never bar them from accessing it, nor their citizenry. So those are just a few of the ways in which some people value or construct models of value around Bitcoin. I hope that answers your question, Mike.
Yeah, good answer. Good answer. And then now, if you want to go explore another interesting area of the campus, feel free.
Let's do it, man. Let's do it. All right. Per usual in the audience, as we make our way over to the campus, it doesn't take us as long to navigate as it does to walk from side to side of UGA's campus, but it'll take us a little moment. So if you want to grab yourself, top up your beverage or anything like that, then these are certainly good times. Do that as we go into our break room, or our meeting room. Breaks. All right. Cool. Go. And next slide, please. As we get into the tokenomics. Okay. So for anybody who may be unfamiliar, tokenomics is simply the economics of a token. And so in Bitcoin's case, some of the pros, it was probably the most fair distribution that we've ever seen and ever will see again. There was no airdrop. There was no farming of the token. It was simply, hey, if you cut your computer on and you dedicate some computational resources to secure this network, then you stand a pretty high chance of earning some Bitcoin through the form of a block reward, a block subsidy. Following that, it is a fixed supply, fixed issuance, excuse me, asset. And so what this means is that people can predictably play around the total number of Bitcoin that exists today, as well as the velocity with which it will enter into circulation, that being new Bitcoin. And these are all really important things, particularly for investors, as it minimizes the number of variables that could impact the valuation or the price of the asset. It's deflationary. And generally, when you have deflationary assets, so long as demand stays fixed or increases, then generally it is pretty positive in terms of price action for that asset. And adding on to that is that Bitcoin has seemed to find a way to lock down a specific use case. That's one of the main critiques of a lot of these other cryptocurrencies that exist, is that they don't need to exist. And most of them don't, to be frank. They do exist as a way to absorb liquidity from the market and for people to sell it and make money from it. That's why there are hundreds, thousands of cryptocurrencies. But then you run into things like layer one networks, L2 networks. And that's when, particularly in the case of L1s, the assets are usually used for a gas token, basically saying, hey, if you want to use this network, this is the native currency to power all of that. And then you get to other instances where people use these cryptocurrencies as a mechanism to allow people governance rights, to express their opinions and vote on proposals and things to be changed around. But for Bitcoin, generally it has been viewed and used by people as a store of value or an inflation hedge. Some people say digital gold, but gold for the most part is used to be a store of value. But in very few cases, we do see this come up from time to time, but that's where things like the Lightning Network come into play. Are people using Bitcoin as an actual payment mechanism? Very rare that you actually see that. Now, on the cons, again, going back to it having a limited use case. But beyond that, the fact that it relies on proof of work mining, at the end of the day, it still is an energy intensive process. You cannot really argue that. Is it the most energy intensive process of any company or organization if you compare it, like we spoke about earlier, to companies like Facebook's or an Apple? No. But it is still energy intensive, and that has its downsides. And it is a fee dependent, or rather, let me rephrase this. After the final Bitcoin is mined and enters circulation, the miners are going to be entirely dependent upon network fees for their compensation, and thus the incentive to secure the network. And that is still an open question because we have not crossed that chasm. We have not hit that point in Bitcoin's maturation yet. But there are some people who have reservations that it will be enough to continue to incentivize miners to keep the network secure. And if the incentives fall out of alignment and miners no longer want to secure the network, then the whole security model begins to fall into a bit of disarray. So that is a consideration. Next slide, please. So, like any great company, even blockchain networks, even Bitcoin has had to pivot over time. And that looks different than a company pivoting, of course. But in particular, the narrative around Bitcoin has evolved over time. When it first came out, it was peer-to-peer digital electronic cash. And then as time went on, and that didn't really gain traction, and we saw things like the Bitcoin Cash, Bitcoin SV, Bitcoin Gold, all of these different forks of the core network, the core chain, that narrative evolved a bit to say, hey, actually, Bitcoin is more like gold. It's more of a hedge. And as we now saw in 2021, 2022, as the inflation issue got out of hand, people began to speak about Bitcoin as being an inflation hedge. So No doubt, this narrative will continue to evolve over time. It may not make as many leaps, but it will certainly change and continue to evolve. Next slide, please. So, next slide again, please. Now, what we're going to do is go through an abbreviated timeline of some of the highs and lows of Bitcoin as a network, as a community, as a cryptocurrency. So, 2008, Bitcoin's white paper was first released. Before that, Bitcoin.org was registered in August of the year, and then the white paper was released that October. Now, many people, I was pretty young, but I did see this impact on my father. Um, 2008 is known as the Great Financial Crisis. So this is when a lot of the major banks began to fail, and really it was the subprime mortgage crisis is one of the core drivers to it. The Big Short, that's probably the most famous movie about this time frame. But Bitcoin was released that same year. 2009, the very first Genesis block of Bitcoin was mined. So I guess you could say technically 2009 is when Bitcoin was actually created, but that's when the first block was mined. And January of that year, version 0.1 update that was released. And then Hal Finney, which is one of the core contributors around Bitcoin in its early days, he was a cryptographer. He received his first transaction in January. And by October, Bitcoin as a network and a protocol received its first difficulty adjustment. And these are common. Usually this happens several times a year where the difficulty is adjusted upward or downward so that the time frame for a block being mined stays around 10 minutes. 2010, Satoshi Nakamoto, he exits Bitcoin development in April, and that is basically the last time anybody ever saw or heard from him in terms of correspondence. In May of that year, 2 pizzas were purchased with Bitcoin for 10,000 Bitcoin. That just puts in perspective what the value of Bitcoin was at the time. If people start putting numbers today on 10,000 Bitcoin being spent on pizza, it's just that is just mind-boggling if you look at what Bitcoin is valued at today, because we're talking several million, tens of millions, and hundreds of millions of dollars being spent for these pizzas. But in their defense, whoever spent this Bitcoin on the pizza, how would they have known that Bitcoin would be worth $60,000 one day? Very likely much more than that at some time in the future. They were just spending it for what it was worth at that point in time. In July of the year, Mt. Gox was launched. In August, there was a $184 billion Bitcoin exploit. Now, thing that's key to notice here is this exploit was patched, and this was not a hack of the network, but more of a computational error in the way that the binary was being handled to represent certain account balances beyond a certain number value. But this was resolved without any impact really to the market. And then in November, Bitcoin reached $1 million in its market cap. Next slide, please. In 2001, the Silk Road debuted in February, and Bitcoin was one of the core currencies being used on that marketplace because of its decentralized nature. In March, Bitcoin hit $1. So even to put back into perspective, a few years prior, people ordered that pizza, they spent 10,000 Bitcoin. If it was $1, they would not have spent $10,000 on these 2 pizzas. In April, there was a Time article covering Bitcoin, and in June, the price passed $31, but there was also a 70% correction of the price. And then August, there was the first ever Bitcoin conference in New York. In 2012, Bitcoin Magazine debuted in January. And fun fact, that is actually where Vitalik Buterin began his career in crypto. He worked at Bitcoin Magazine. And in May, the FBI, there was a report that leaked that they were basically following, studying, monitoring what was happening with Bitcoin. In June, Coinbase was founded. In September, the Bitcoin Foundation launched. And in November, there was the first Bitcoin halving, where the miner reward, the miner subsidy was cut in half for the first time. In 2013, FinCEN formally addressed Bitcoin acknowledging it for the first time. In March, it hit a $1 billion market cap. In May, the first Bitcoin ATM debuted. And then in October, the FBI shut down the Silk Road. Next slide, please. In 2014, in February, Mt. Gox lost over $450 million of customer funds. That still has not been resolved. There was actually supposed to be a disbursement, or rather an auction of a lot of the assets that did remain from Mt. Gox, but they chose to delay the sale of those Mt. Gox coins and put that off because it was supposed to happen earlier this year. In March, Newsweek identified "quote unquote" Satoshi Nakamoto. Of course, they never did, but there was a gentleman in Japan whose name was actually Satoshi Nakamoto, but that is not Satoshi Nakamoto. In July, New York proposes a bit license. In July, as well, Tether launched. At the time, it was called Realcoin, and then in December, the Central Bank of China banned Bitcoin. In 2015, Ethereum launched in July, and in 2016, we saw the first ICOs get off the ground. Craig Wright claimed to be Satoshi Nakamoto. He subsequently found himself in a very protracted court battle trying to prove that he was Satoshi Nakamoto. In June, Ethereum suffered the first DAO hack, and in October, Zcash launched. Next slide, please. In 2017, we saw SegWit activate on Bitcoin mainnet. This is one of the first major foundational tech changes to the Bitcoin protocol. Basically, SegWit is short for segregated witness, and it affected a bit of how transactions were verified, and it didn't change the consensus mechanism, but it was one of the first fundamental changes to Bitcoin. It was a big deal. Not everybody was in favor of it. There's still some clients that operate and don't use SegWit, but it is definitely the vast minority of people who don't. In August, Bitcoin Cash forked out of the chain that we still acknowledge today as being Bitcoin Core. In December of 2017, Bitcoin reached $20,000. And in that same month, the first futures contract began to trade on the Chicago Mercantile Exchange, the CME. And it was within days that the Bitcoin price collapsed. In 2018, BitConnect was ordered a cease and desist. They were a network marketing company built around Bitcoin. And after investigation, they were deemed to be a Ponzi scheme, so they were shut down. And Bitcoin bottomed at $3,300 in December 2018. In 2019, Square announced its crypto division. And in May, the Bitcoin improvement proposal of Taproot was proposed. And both SegWit and Taproot were fundamental changes that opened the gateway to things like ordinals being possible. Next slide, please. So in 2020, there was the Black Thursday crash. There was another Bitcoin halving. Black Thursday crash came in March of the year around the news of COVID-19. And the rest of the market's just capitulating. MicroStrategy bought tens of millions to hundreds of millions of Bitcoin in August. PayPal began offering crypto services in October, and Bitcoin reached $29,000 in December of 2020. In 2021, Tesla made its first purchase of Bitcoin in February. Bitcoin surpassed $1 trillion in market cap. Canada launched its first Bitcoin ETF in April. El Salvador made Bitcoin legal tender in June, and there was a large shift of miners out of China in May and June. And that's supposed to say 2022. That's a typo, and I made this presentation in 2021. But we saw in 2022, there was a lot of sideways action. There were a lot of people stepping back from crypto as a whole. And obviously the price continued to slide down. Now, in terms of Bitcoin and its survival, another quote for you. The future life expectancy of an idea or technology is proportional to its current age. The longer something has been around, chances are the longer it will survive. And this is known as the Lindy effect. So there are There's a lot more to this presentation, but I'm going to go ahead and pause for a second in case there are any questions.
I have one more question. How do
Yeah.
the people who were involved at the various periods of up and downs handle the wide volatility of the Bitcoin pricing? I mean, it must have been very difficult. I mean, people who got in early made a lot of money, and then it collapsed, and then it came back up, and now it's sort of in the middle. How do people manage it psychologically?
Great question. And the short answer is, it's a bell curve distribution. The 68.8% or whatever it is in the middle of that curve, they handle it pretty poorly or average, I would say, which is, they do okay. And then you push to the extremes. Actually, no, I stand behind what I was initially saying. Most people don't handle volatility well. They try to avoid it. And so what that looks like is people sell the moment that they're uncomfortable. They capitulate. Same reason why when price begins to go up, people FOMO, and what that means is fear of missing out, and they can't manage that emotion, and so they chase the price. And so it's this vicious cycle where they buy too late and they sell too late. And so that's what happens to the majority of people. That's why most people never make money when they trade. That's why most people never really make money when they invest in anything other than an ETF, because they can't really manage that volatility well. Even the best of the best don't always manage that volatility well. But I think that what people really aim to do, the people particularly who seem to have the best track record, is you put as much data around your decision making as possible. You remove as much emotion as possible from the decision making process so that you can make more grounded decisions that are supported by data and not hunches or feelings. And I think that that's the best way to do it. And I think that beyond that, it is still a fundamental question of risk management. Don't overinvest, and have targets, have objectives, so that you can more easily make those decisions about when might be a good time to sell or get out. And that goes back to what we spoke about briefly in our prior conversation about dollar cost averaging, and why that is in most situations the absolute best method of investing for 99% of people, because you set aside an allocated amount and then you invest it regularly. So it removes the question about how much one is going to invest, and it also removes the uncertainty of when one should invest.
Thanks for that.
Uh,
The volatility, though, is significantly more than, let's say, the stock market or even the currency markets. So it's got to have take a toll on most people.
Definitely. But I think that's why the majority of people still don't have any exposure, right? You have these waves of adoption. You have the early adopters, you have the late adopters, you have the mainstream, then you have the laggards. And the risk to reward adjust with that. It's infinitely less risk, excuse me, to allocate to Bitcoin today than it was in 2009 or 2010 or 2011 or so on and so forth. And as time goes on, regardless of the market cycles, as the Lindy effect posits, and as we see from capital allocation in the likes of BlackRock, vying to open up an ETF, a spot ETF, it's going to be easier to access. There's going to be more quality information around it. There are going to be more people allocating substantial capital to it. But what that means is you get to a point where there's less potential to make money on it. That's the whole risk reward profile of venture capital. You find companies often before they even have a product or before they have any product market fit. And the idea is that the earlier you get in, you do take on more risk, but that's actually what puts them in position to have 10,000x returns, 1,000x returns, 100x returns. Sometimes for VCs, 100x return is a bad return. 30x is a bad return because they take on so much risk. of their investments, and most of their investments do go to zero, or they write them down to zero, um, which offsets their gains. So it's not like it's a boohoo for them. They're all definitely tax optimized. But anyhow, yeah, all of us in this room, we're not the early adopters, but we are an early adopter cohort. You know, by the very nature of the fact that we're sitting here in this metaverse setup having a presentation.
You're right. You're right about that.
Okay, next slide, please, and I will power through the rest of this. I have a couple moments for questions. Next slide. So, in general, there are three main concerns that people have had over time, and that were still around in the last market cycle bull run. That being concerns of legitimacy, a lack of regulation, lack of regulatory guidance, clarity, and the technology being quote unquote unproven. And so, on the legitimacy front, there are multiple studies that have been done, and there is still far more, orders of magnitude more money laundering being conducted with fiat through institutions like Wells Fargo than there are um, taking place through Bitcoin. I encourage anybody to look up the number of times that Wells Fargo has been sued for either fraudulently creating accounts so that people who work at Wells Fargo could get bonuses, or the number of times they've been implicated in laundering money for cartels and the triad and some of these other organized criminal organizations. And they've been doing that a lot longer than Bitcoin's even been around. So this is, I think, a much more of a political point that got pushed, but isn't statistically and data does not support that is the actual core use case of Bitcoin. So second one being lack of regulation. We have a lot more, we're making a lot more progress on that front, but there's still a ton of ambiguities around Bitcoin. And we're seeing this lead to institutions like Coinbase setting up shop in other jurisdictions because the clarity they find is much easier to gain in these other places than they have found it to be in the US. And as far as the technology being unproven, as we spoke about earlier, there are still limitations on Bitcoin as a base network and a base chain. It is not good for payments right now. And Lightning has very slow adoption as a second layer or layer on top of Bitcoin to make the payments case easier. But all these things are being worked through. Next slide, please. So why is Bitcoin adoption growing? Next slide. Technology shapes society, and society shapes technology. Robert W. White. Next slide. So, one of the core factors is simply market cycles. Every 4 years, roughly, Bitcoin goes through this halving process, and that has tended over history of Bitcoin being around. That has also lined itself up quite well with different market cycles. Now, granted, now that we are at the inflection point that we are from a macro standpoint, there's a big question on how things will play out in 2024 and 2025 as the next halving is in 2024. But this has been one of the driving factors of Bitcoin is its cyclical adoption nature. So in the big picture, you have things like the quantitative easing and the inflation, and people are looking for ways to preserve their capital. And Bitcoin, typically, it has preceded it. It absorbs liquidity ahead of the inflation, and then as the inflation is identified, as it is broadcasted and spoken about more in the media, that's usually the stage in which Bitcoin begins to sell off and give some of that liquidity back to the market as people risk off and capture their gains. The second reason being institutional adoption, i.e., the smart money coming in. In 2020 and 2021, we had Ray Dalios, the Druckenmillers, the Paul Tudor Joneses, the Anthony Scaramucci's, all speaking about Bitcoin in the press, all in different ways, making implicit and explicit endorsements of the asset class and the technology. And now that we see firms like Larry Fink's BlackRock, Fidelity, and many other State Streets, them come in and ask to offer spot Bitcoin ETFs, once these things get approved, I don't think it's an if but a when, they will literally funnel tens of billions, if not hundreds of billions of dollars of capital into the asset. And I think that people will be shocked at the effect that this may have on the price of Bitcoin. And then lastly, visibility, accessibility, and good PR. So PR was good in 2021. PR is bad right now. But things like BlackRock and the institutional allocators, they drive that visibility forward. And that's only going to increase as we see things like PayPal, issue its own stable coin as they get deeper into this technology, as we see banks and countries start to issue their own cryptocurrencies. Any cryptocurrency project, Web3, is all really built on the back of Bitcoin. Next slide, please. And next slide. So what are the tailwinds that we have for Bitcoin? Well, we have regulatory clarity. We're going to see more countries make Bitcoin legal tender. We're going to see more sovereign wealth funds allocate to Bitcoin. We're going to see more countries that simply want to increase their exposure to Bitcoin in their war chest because they want less restrictions on the global scale when it comes to these financial rails that we talked about earlier. The other financial applications, they are going to continue to improve the accessibility to Bitcoin as an asset. ETFs being a major vehicle of that. And as people are able to allocate to Bitcoin within their IRAs, their 401ks, this is also going to be another source of liquidity for the asset. And then social drivers, the tech will continue to improve. People will continue to find creative ways to leverage dormant energy to mine Bitcoin. And people will continue to work and press ahead on the community and tech front to make Bitcoin more compatible with the current state of the world. So in closing, on this last slide, we tend to overestimate the effect of a technology in the short run and underestimate the effect in the long run. Roy Amara. And that is the basics of Bitcoin.
Thank you so much. I learned so many things.
Thank you so much.
Absolutely.
Informative.
Welcome. Awesome. Well, as always, I appreciate everybody making the time. And if you have any questions, feel free to DM me on Twitter. It's at Native Assets. You can also reach out on LinkedIn if that's your preferred platform. But between either of those two, you should have a pretty easy time getting a hold of me. And as always, big shout out to Third Academy, to everybody here for helping organize this and get this together and allow the space for us to have these conversations. They're really important and are increasingly important as time goes on. And until next time, I'm Sae'Von Springer, founder and managing partner of Native Assets, host of A Bit of the Block, signing off. Y'all have a blessed day. We will see y'all